The widely anticipated rate hike couldn't come soon enough, as inflation in the US hit a 40-year high of 9.1% last month. While Fed Chairman Jerome Powell was emphatic that the US is not in a recession, his tone was less hawkish than market watchers had hoped. Analysts say this highlights the fact that nobody, not even Fed officials, are certain just how much tightening is too much.
He worded it interestingly, and I think he worded it well when he said the path to a soft landing, to not having a recession and still curbing inflation, is a very narrow path, and it's getting narrower. That's his way of saying it's unlikely that we're able to do this. We still think we can, and we're certainly going to try. But in all likelihood, they are going to need to, we probably are going to go into a recession. The good news is it's probably likely to be a mild recession.
We are faced with somewhat of a peculiar situation where we've had a conspiracy of supply side shocks in series. We're still unsure whether the interaction between these and the sequencing, how it would impact inflation at the end of the day. And the second aspect of policy is not only is this policy tool really targeted to demand side inflation and not so good with supply side, but also it acts with a lag. So it's almost like waiting for your echo to come back from this cave, and you just don't know how deep the cave goes.
The one indicator keeping recession fears at bay is US jobs data. In June, the US unemployment rate held at 3.6%, close to full employment. Analysts say the Fed will be keeping a close eye on this indicator before deciding whether to loosen or tighten policy in September.
It is really a case of how resilient is the labor market. It's still holding up because jobs are still being created. There's still spending, although signs of spending cooling off has emerged. But if they still stay strong and prices stay relevant and elevated, then we still may find that the economy still have momentum. But I think this is where it gets interesting. We do clearly see that from the first batch of prelim PMI figures reading for the major economies in both Europe and the US, we have seen pullback in some of the services industries and sectors.
Despite the Fed's best efforts, inflation shows no sign of cooling down anytime soon.
Inflation pressure, in our view, would likely stay elevated through the summer. We do see the Fed hiking to as high as 4% before they pause. And this is because historically, what we found is that inflation can shoot up like a rocket, but it comes down like a feather. Although some commodities right now are showing signs of peaking, the key issue today is that shelter and core services inflation continue to rise. And history tells us that these categories are sticky and they don't turn on a dime. Especially so that these the drivers of inflation tend to be strongly correlated with wage pressures. And we do know that the US labor market is continuing to hold quite firmly.
And this is where experts disagree. Some feel that between inflation and recession, it's more important in the longer term to get a handle on inflation, even if this means pushing the economy into recession territory.
In a recession, what you get is you get a few quarters of a downturn. So what it necessarily does, at least initially, is it affects your cash flows and your profits, if speaking very broadly. After which, once the excesses are gone, the ability for productivity to pick up again means you can restore your profits and you can get back to a situation where you have growth. However, with inflation, the fear is not only do you get your purchasing power eroded, so you've got for the corporates, you get your profits destroyed by the cost shocks. And then for the households, you get your wages, your discretionary income destroyed by inflation. It's a huge tax. And I think anyone from any position frowns upon such a tax that comes to the detriment of all. So if that prolongs, the fear is that rising inflation more permanently damages productivity. You can't restore productivity as quickly. And therein lies the problem.
Analysts agree the likelihood of even more tightening ahead spells trouble for Asia's export-reliant economies.
We will see slower demand impacting those more exposed to trade, global trade, China, Singapore, China, Hong Kong, for instance. Others may have a little bit more resilient in domestic demand, still with commodities helping out, but higher inflation and also higher cost of borrowing for all of them is a question of how much and how will be brought forward or will be spaced out.
So how should investors prepare for this uncertain environment?
We believe that it is extremely important for investors to examine on a bottom-up basis assets and companies that will perform well even in inflationary environments. And these tend to be companies with defensible business models and profit margins that hold up well even during times of inflation.